Today we will be discussing what makes more money, stocks or ETFs. So, when we think about stocks and ETFs, well, what is a stock? A stock is an individual company, right? An ETF makes up a broad, diversified group. Many different companies or commodities or whatever, all into one. A large exposure. So, stock, concentration, right? ETFs, diverse, less, more. So, one, more exposure to many companies, less exposure to a few. But this comes with more risk. This comes with less risk. So, which is better? Well, one has a greater possibility reward. One has more safety. So, in reality, the reality is that you can do better in stocks. You can achieve more reward, but it's going to be more risky. And for a greater amount of people, you're going to have a good downside. ETFs, you're going to have safety. And for a greater amount of people, the average, you're going to have a guaranteed return, right? Because you probably, on average, are not going to be an exceptional investor that is able to pick companies at a rate that beats the market. So, for the average person, the ETF is superior. And overall, if you think about the entire market, people invested, overall liquidity, ETFs make more people more money because diversification, what it does is it changes psychology. How people feel about the market. So, when you are in a diversified ETF, right? You're not constantly sitting there fretting if the markets go up or down. You're not watching it with the same intensity. And what's important in investing and making money like this is not really which does better, picking the one, all this other stuff, yada, yada, yada. It is your psychology. It is how you go about this game. Because long term, people who are holding have huge tax advantages, right? People who are dollar cost averaging for the long term, huge advantage. So if you are using a ETF, your frame of mind is going to be better than if you were investing in a stock. Even if you were trying to invest in a stock for the biggest gain, odds are being completely unemotional and investing for the long term would make you the most money in a so-called winner, right? If that stock was a winner and it was continuously positively going up or overall trending up in a long term, like Nvidia or like Tesla, like Apple, like Microsoft, who were the people that made the most money off those stocks? there were people that were highly convicted about the stock. They had a high conviction, and they continuously invested in it over time, right? They dollar cost averaged into it over the long term. And that allowed them to make excessive gains because they were continuously buying and they got good prices, and they, over time, had an exceptional gain because of compounding. And over time, compounding is the greatest way to make money of anything. And ETFs give the people mindset to actually take advantage of compounding, right? So, the reality is that most people don't have the right psychology when it comes to investing. And just investing in an individual stock is so psychologically taxing. It's so hard for everyone. Even great investors have very, high stress when it's related to these individual stocks, when they're taking a large position of their net worth. That's very stressful. That doesn't allow for the right psychology in thinking about the markets to emerge. So that is why ETFs make people so much more money, is that they can be in the right frame of mind. They can be dollar cost averaging for the long term, monthly, without even looking at the markets. The best advice, the best investing advice that anyone can give to you is to simply invest in a 401k for tax advantages. For the average person that's retiring, 65, invest in a 401k into the market averages and set maybe a little bit more aggressive amount taken out of each paycheck than you would like to in the beginning, but that you can survive, right, off of, and have that amount go into the market average in a 401k every single month. Don't look at it. Don't touch it, don't look at it, don't even think about it. And psychologically and statistically, that is probably one of the best things for the average person to do, right? Unless you're maybe on the crazier side, like myself at times, and think you can beat the market average. Which, if you're going to do it, like my system, like I said, 10% enterprising. Right? Because that will allow for you not to be wiped out in those beginning years, but still the rest will be in a combination of cash, 1, and then 4, S&P 500. 80% S&P 500, 20% cash with that 90%, and then 10% enterprising, where you have a chance to beat the market average over the long term through trials and errors, right? You can potentially be a good investor and take advantage of that high reward, but you will also incur a high risk. And in the beginning, you will be losing, right? Cost to become a great investor. So in the beginning, in this 10% enterprising, expect to lose money, right? But be educating yourself and gain value from this enterprising amount. While the other 90%, which is mostly in the market average, mostly taking advantage of tax advantages that come with dollar cost averaging and investing into the market average for the long term, we'll be in the S&P 500. We'll just be in the markets. There is no thinking. None has to be done. It rebalances at 20% cash just balances out. That's all. Standard portfolio, low risk. And the rest, 10%, you will be paying your dues to become a great investor. And in that 10%, if you keep trying and you become an expert, right? You read more books than most people. You spend more time than most people. And you put in more than 90%, even the average fund managers, right? Then maybe you can be one of the successful enterprising investors that beat the market average. But I would expect when this portfolio for the first couple years to do just a slightly bit worse than the market average, because your enterprising amount, that 10%, probably going to be losing money. But if you go on to become great, then maybe, right? Here's the beginning. Here's the market. Here's you. S&P. The beginning. You're doing worse to start. Maybe even lose a little bit more in the dips. But maybe after a long time, you finally beat the average. Many years from now. And that's why I recommend this, because psychologically is the best way to ensure that you build wealth, but you also build the intelligence to be a great investor and build your own wealth long term, rather than just riding the market average. But with the majority of your money, you will be riding the market average. And with that small bit, maybe you will outperform the average. And that, in conclusion, is ETFs versus stocks. What actually makes more money?